Welcome to This Explainer. Today, we're diving into a fascinating company that, honestly, you definitely know, but the market might be completely misunderstanding right now. We're going to evaluate if Moody's Corporation is actually a smart investment today by stress testing their buzzy, modern AI and data growth narrative against the cold, hard reality of their business economics. Let's get right into it. So, we're kicking things off with a pretty massive central tension. When you hear the name Moody's, you almost certainly think of credit ratings. But recently, Wall Street has been pricing Moody's like an AI and data services darling. They're pitching themselves today as this integrated risk platform. So we really have to ask, is the market's perception of Moody's as a highly durable, recurring revenue tech powerhouse actually justified by reality? Or is this just a great business trading as an overpriced stock? To figure out if Moody's deserves your capital right now, we'll quickly move through 5 steps: the core business reality, their evolution and strategic moves, testing that growth narrative, valuation and risks, and finally, our investment verdict. All right, part 1, the core business reality. To really understand Moody's today, you've got to realize it's basically split into 2 distinct segments. The external revenue split for 2025 is surprisingly balanced. You've got Moody's Ratings bringing in over $4 billion, with Moody's Analytics right behind it at $3.6 billion. But here's the catch, and it's a big one. While the analytics side provides a massive, steady stream of revenue, the traditional ratings business absolutely still dominates the overall profit pool with significantly higher margins. So think of it as an elite ratings franchise that happens to have a high-quality analytics arm attached, not the other way around. And that distinction is absolutely crucial. Analytics gives Moody's that software-like stability everyone wants right now. Actually, an incredible 96% of its revenue is recurring. Investors absolutely eat that up. But the ratings side, the side bringing in the heaviest profits, is completely transaction-linked. That means the company is still heavily exposed to the cyclical ups and downs of global debt issuance. If interest rates spike and companies just stop issuing debt, Moody's profits take a very real, immediate hit. Moving to part 2, evolution and strategic moves. So how exactly did management build this dual-engine machine? Well, following the 2008 financial crisis, they obviously had to do a lot of reputational and legal repair. But starting around 2017 with their Bureau Van Dijk acquisition and then RMS in 2021 under current CEO Rob Fauber, they executed a major pivot. They basically took their immense cash flow and made really disciplined acquisitions, expanding their reach deep into private company data, compliance workflows, and climate risk modeling. When we evaluate management across the key dimensions here, they actually earn some really high marks. We're talking strong scores on vision, operational execution, and financial management. They've shown great capital discipline by sticking to sensible data adjacencies rather than just recklessly trying to build an empire. However, we're giving them a fair on stakeholder communication. Why? Because right now, leadership is leaning incredibly heavily into AI and private credit buzzwords, even though the proven long-term economics of those specific areas are still a bit up in the air. Which leads us perfectly into part 3, testing the growth narrative. We really need to stress test this modern growth story they're pitching about being an AI-fueled integrated risk platform. Right now, private credit is just exploding as a massive growth driver for them. Revenue in this space shot up 60% in 2025, and then spiked over 80% year over year in just the first quarter of 2026. It's undeniable, rapid expansion. But as a careful investor, rapid growth in a relatively new, opaque sector is exactly where your radar should start going off for hidden risks. Let's look at both sides of the coin here. The bull narrative sounds amazing on an earnings call, right? AI distribution, monetizing the private credit boom, embedding their data into every financial workflow imaginable. But the skeptical reality is that these ambitions carry some serious friction. The company itself is actively warning about heightened regulatory attention and potential litigation in the private credit space. On top of that, while AI might make their products better, it just doesn't have the proven deep moat economic returns of their traditional, federally recognized ratings business. Now for part 4, valuation and underlying risks. This brings us to arguably the most critical part of this entire memo, the price tag. Because look, a great company can still be a terrible investment if you pay too much for it. And the number you really need to keep in mind here is 31.2. Trading at roughly 31.2 times trailing earnings as of May 2026, Moody's is commanding a massive software-like premium. That steep price tag leaves you with practically zero margin of safety. If the debt issuance market normalizes, or if those AI revenues don't magically translate into highly profitable subscriptions, that multiple has a very long way to fall. We also have to face the balance sheet reality of how they actually built this modern platform.
A lot of their progress was bought, not built organically from scratch. That leaves them carrying massive goodwill. We're talking over $6.3 billion of it, alongside some huge acquired intangible assets. And to compound those capital allocation concerns, management is aggressively buying back their own stock at these premium multiples. Now, buying back stock is usually great, but doing it when your shares are priced for absolute perfection, that's a pretty questionable use of shareholder capital.
Finally, Part 5, the final investment verdict. Balancing this undeniable business quality against a highly demanding valuation and unproven AI growth leads us to one absolute core takeaway. An exceptional business does not equal an exceptional stock price today. Moody's is, without a doubt, an elite, top-tier franchise. It boasts incredible margins, a massive economic moat, and a highly competent management team. But the current entry price simply does not compensate you for the risks. You're basically paying a premium software multiple for a business that still heavily relies on the cyclical whims of the debt market and is facing real regulatory scrutiny in its fastest-growing areas. So, until that valuation comes back down to earth, or until the analytics segment can definitively prove it can dominate the profit pool without sacrificing those juicy margins, our final verdict on Moody's is simply admiration without purchase. It's a phenomenal company to study, but right now they're asking you to take on way too much narrative risk for the price. You have to ask yourself, are you buying a proven impenetrable moat, or are you just paying top dollar for next year's AI buzzwords? Thanks for joining us for this explainer, and keep questioning the narrative.